Good morning, everyone, and welcome to today's ECA Coronavirus Impact webinar. Today's topic is managing financial challenges. We'll be discussing some of the financial challenges being faced by businesses in the current environment. Our expert panelists will advise on what steps can be taken to reduce the impact of these developments and how businesses can improve their financial position. Our panelists today are Alison Warner. Allison helps construction and trade businesses grow their sales and profits and build effective teams. She's the founder and director of business coaching company Evolve and Grow Limited. Allison is also the author of Build and Grow, How to Go from Tradesperson to Managing Director in the Construction and Trade Industries. Also joining us today, we have Tony.hawkes. Tony is an asset financier and appointed representative under the umbrella of Asset Finance Solutions UK Limited. Tony has extensive experience in finance and funding and helps SMEs acquire business critical assets to take them to the next level. Hosting today's discussion, we have Rob Driscoll, ECA's Director of Legal and Business, who will also share a brief update on the most recent coronavirus-related developments and government guidance. Before I hand over to Rob, just a quick reminder that you can ask a question at any time using the Q&A box on your screen, and our panelists will be answering as many of your questions as possible at the end of the webinar. And finally, viewers are reminded that a replay of today's session, as well as replays of other ECA webinar series are available on ECA's YouTube channel, and that's at youtube.com/ECA Live. And for more information and guidance and a wealth of material related to business recovery at these times, visit www.eca.co.uk/business-recovery. And we hope you enjoy the session. Over to you, Rob.
Thank you, Omar, and welcome, Alison and Tony. What we've tried to do over the past couple of months is we've spoken on our webinars about how the furlough system has evolved and changed during the lockdown period, and now we're looking at unfurloughing. We've touched on contractual issues going into it, how you audit your supply chain, how you look at your business from a commercial perspective, and make sure that you have made it as resilient as possible. And then we also have touched on some of the contractual disputes and how to leverage your position under general industry standard forms of contract. We've also taken you through a number of key government announcements as they've evolved, and there have been more this week as we try and keep members appraised. During that period, we've listened to feedback from our regional management team, feedback from our inquiry desks, and feedback right across the board from you, the members, including at your council level, where you run the association between you as a membership. And that feedback demonstrated that there were some problems at the smaller business end of things in terms of presenting yourselves financially in a sustainable, robust way to the market in order to access some of the government lending systems. And as you know from previous webinars, ECA is represented on the Construction Leadership Council COVID-19 Task Force, which is the government's conduit into the construction industry to manage and deal with the issues surrounding COVID-19. One of the work streams below that, one of the many work streams ECA has been involved in, is business support and finance systems. So actually, the chairman of my committee, who is an ex-finance director and managing director of one of the ECA member businesses, has been involved in trying to represent your interests in those groups and feed that support in. Before we dive in and we get Alison and Tony involved, I wanted to just touch on some of the backdrop towards the economic climate, because it's very easy to feel quite alone at the moment and quite like you're the only one going through your particular circumstances. Early April, I think it was the 9th of April, this was released. It's taken from the Office of Budgetary Responsibility, their prediction or their scenario plan, because it was highlighted that this was only one scenario in a multitude of possibilities, which outlines the potential impact of COVID-19 on the UK economy. It's on the far right that you see the crash. It's in a V crash, not a W or a U or any other economic letter descriptions as to how this might work. The interesting thing is when you look back across the historical timeline there, it is bigger by far than any other World War or Spanish flu type economic crash resulting from it, which might then lead us to explain why the current political climate on the press briefings every day is very much geared towards, well, this is unsustainable economically. So with the health risk in mind, the politicians who are in power are trying to reopen the economy. And of course, our part of the economy was never shut. Construction in England and Northern Ireland, and to a large extent Wales, has not been shut at all. It was only shut down in Scotland. If sites or particular facilities management issues or anything, or consumers decided to suspend or shut, that was a private decision between the client and the contractor. We did see a crash, and here is outlined in this OBR report that construction by far will be one of the biggest parts of the economy that crash. Now that causes government concern for two reasons. One of the slides I haven't actually included in this is if you look at the macro output of construction, it's roughly 100 billion economic contribution. The FM world, including infrastructure, is about another 122 billion. They employ around 3 million jobs and roughly 315,000 businesses are involved in that. But 99% of those are SMEs, spread over on average 4 to 5 levels deep in a supply chain, which tells you that our economy is enormously fragmented, enormously disaggregated, in other words, spread out throughout the supply chain. And therefore, government support needs to get to where it needs to be, and that's taken on board. Now, construction doesn't tend to reach the mainstream media. It's not that interesting when it comes to TV channels and other parts outside the trade press, but it is a significant economic enabler because that construction output, combined with the FM and infrastructure, enables a further £547 billion worth of wider societal economic contribution. You guys forget you build, maintain the schools, the libraries, the shops, the leisure centres, all those businesses that are shut or unable to keep going. And regardless of what the future activity looks like, it's important to realise that even when you stop building new stuff, you inevitably have to sweat the assets, as they say, and maintain existing stuff in the built environment. So where does that leave us? We've enormously densely crowded sector. Engineering services has faced a plethora of government announcements over the past 6 months. And here you see that at the very biggest end, we had an announcement even on the 20th of May that you can get 125,000 right through to £5 million loans, but they must be matched fund by private investors. These loans can be very useful if you are pre-revenue or pre-profit status. And what we might do is ask Tony and Alison to have a view on whether that will have any kind of significant impact when you're in a trade style business. I do know of some ECA members who have had angel investment or equity capital investment before, but that may just be at the larger end because of the nature of the way those large businesses can accumulate cash at any one time. Bank of England liquidity corporate financing system, where they basically purchase paper debt at a very large end of the scale in exchange for restructuring the corporate funds profile of some of those businesses. Again, it has limited relevance to ECA members. Moving down into the place where actually you can see where some of these schemes might be more relevant to us. You have this coronavirus business interruptions loan schemes. They came out and it was 0 to 5 million under what was quickly nicknamed the civil system. It largely requires you to use a but-for test. But for COVID-19, my business would be pretty resilient, sustainable, and fairly healthy. You have to demonstrate that the banks might call it the viability test. It's accessed through the British Business Bank. It's not a loan with government. Government are guaranteeing to lenders, i.e. high street banks and other banks, that they will cover 80% of the bill if you default. The interesting evolution point there was that was largely inaccessible to construction because of the size of many of the businesses and the requirement from retail lenders when they did due diligence to get some kind of personal guarantee. That was removed by the Chancellor in April, where anything under £250,000 worth of loan would not require personal guarantees in that sense. The loans run over around a 6-year period and can run up to turnover of 45 million. Then along came the coronavirus large business interruptions loan scheme. Large company lending of turnover of more than 45 million could get in the region of 50 million. That has been increased this week so that they can get around £200 million worth of loans. Because again, I guess what the government economists are doing all the time is examining the data, how much loans have actually been given. All the banks are asked to report, and so that they can see how much of an effect these measures are having in terms of fiscal intervention designed to minimise and mitigate the impact on our economy and lessen the depth of that V on the OBR graph that I showed you earlier. There is a new requirement, certainly under the large business loan scheme, to not necessarily pay dividends, but have restraints on senior pay. Concern obviously here, whether it's big bounce backs, the usual civils or the large civils, would be what happens if the business gets the loan and then dishes it out in dividend and folds. Where does that leave the government or the banks? There is also a further measure in business-to-business transactions, which was announced this week, whereby if your transactions are covered by trade credit insurance, government will now guarantee the payments provisions under those transactions. Now, that's had mixed reviews in our sector because many contractors don't or can't get trade credit insurance. The common denominator around all these schemes is government sits behind the front line. And the front line on trade credit will be the insurers, them doing the due diligence, not giving trade credit insurance unless they are satisfied within the due diligence exercise that they are a viable prospect to sell that insurance to. In other words, they're not going to get a call too much on it because these are well-run businesses. And just like the civil system, again, government sat behind the banks and let the 40-plus banks do all the due diligence and take all the sweat and the toil away from it. Which leads me to a practical point. Reports were that it was anything from 4 to 6 weeks because call centres with banks were experiencing 4 times the level of demand than they were set up for. So the most recent, probably the most useful intervention, anything from 2 to 50 grand, the bounce back loan came in. 12 months, interest free, and then fairly reduced low interest for 6 years thereafter. More or less, very low threshold, fill in a form online to try and get that. Does that help in our area? Well, again, mixed reports depending on what size you are as to whether that just buys you a month or 6 weeks of cash flow. The important thing I think to know here, and again, the other guys might have a view on this, is you need to be aware that there might be certain restrictions. This isn't a case of I can have all of them. I've already outlined that banks will determine what you can have, but there may even be restrictions. If you have access to certain support measures, i.e. a bounce back loan, you can't then apply for the civils loan. A further support, and this is a grant, not a loan, but quite important, small business grants, 10 grand, should be dished out straight to you if you fall within the threshold of the small business rates relief. It's issued by the local authorities directly to you, so they should be writing to you. You can find online a link to Find My Local Authority if you don't know it. And the other important point to note is if you were a small business, but somehow you had multiple locations, and suddenly one office fell within one local authority and another in another, you would get the 10 grand per location or per local authority. So that's quite important. Then those final points there, personal loans, mortgages, tenancies and commercial tenancies. The government right at the start of COVID-19 did outline that they expected lenders, landlords, etc. to be very lenient and certainly to give people some kind of 3-month mortgage holiday and not to go straight to evictions on tenancies and other issues like that. However, I would emphasise that you should be having proactive conversations and not simply ignoring that and saying, well, government told me I'll get a holiday. It does require people people are much more receptive, including lenders, if you have an upfront, honest dialogue, and that's got to be on a fairly open book basis, which isn't always comfortable for our industry, I must say. So over to Alison.
Okay, thanks very much, Rob. Well, thanks for inviting me on today. So I thought it would be useful just to go through some things that may help you if you're deciding to go down one of the routes. Certainly if you're looking to apply for a CBILS, or maybe you already have, the bank will certainly ask for a lot of information, including year-end accounts and cash flow forecasting and financial analysis of your business. And I think a good place to start is perhaps, I'm guessing that a lot of people on the call, certainly if you're at the smaller end, in terms of you own a small electrical business. Sorry, my slides have just disappeared, Rob. I don't know if you can get them back up for me. Okay, I've got my points here somewhere. Can you still hear me, guys?
I can, Alison.
Okay, I will press on, assuming that everyone can hear me still. Oh, the slides have come back up. Sorry about that. So yes, the first point I'd like to make is that as an electrician or an owner of an electrical business, you have been trained in electrics, not necessarily how to run a business. That's not to say by any stretch of the imagination that you're not running a good business, but it's a little bit like me trying to go out and rewire a house. It's not my specialism and I wouldn't attempt to do it. However, if you own electrical business, first and foremost, you are a business owner who happens to be an electrician rather than an electrician who's running a business, and I think there is a difference there. And so a lot of the information that banks will request requires you to have your business head on. So I think it would be a good place to start by just talk through these points. The first thing is, I mean, it's always good practice anyway to know your numbers. We work predominantly with trade businesses turning over probably $250,000 up to about 5 million. And through no fault of their own, has anybody ever really explained the difference between these terms? So apologies if you are up to speed on all of this. I don't want to teach anyone how to suck eggs, but I would say 95% of people that come to us aren't fully aware of these things. So it's about being close to your numbers and understanding what percentage of sales these different elements are. And this is what we call common sizing. So it's where we express our costs as a percentage of sales. And roughly speaking, the materials in the electrical business should be anywhere between 32 and 35% of sales, generally in the smaller end. Direct labour is probably going to be similar, which will give you roughly 30 to 35% gross profit percentage to then cover your overheads and make sufficient net profit to pay yourself and retain some profit to reinvest back in the business. So it's about having an understanding of how your business is operating at those levels. And then it's about knowing where you're going. And this is what the banks are really interested in. They want to know, do you know your numbers? And do you have an idea of where you're going in terms of what sales are you expecting to turn over in the coming weeks and months? Now, none of us have got a crystal ball. I'm being asked frequently at the moment, what do I think is going to happen? And I don't have a crystal ball either, but we can take our best guesstimate and then check in against that regularly. So there's two key points here in terms of knowing where you're going. First is to make sure that you're quoting accurately. So when you're putting your quotes together, that you are working out the materials as a cost to you, not what you put on the quote, and what percentage are they of net sales. That's the price that you're charging the customer without VAT. So that's the first thing. Make sure you start off on the right foot. And then the financial forecast, they're looking for the next 12 months generally. And that is really anticipating what do you expect to turn over in terms of net sales in the coming weeks and months. What proportion of that would you be spending on materials? What proportion on labour? What do your overheads look like? And if this isn't an exercise that you have already done, this is something you should definitely be doing, looking at what it costs to actually run your business. So an overhead is a cost that you have to incur regardless of whether or not you make a sale. That's the difference between a cost of sale and an overhead. So for example, it could be some software that you pay a license fee for every month. That is an overhead. Or it could be an employee. And now at the moment you may have them furloughed, but obviously once they come back, they still are an overhead. And so going through those overheads and really looking at each of them and asking yourself honestly, right, is this absolutely essential for my business? And if it is, can it be done in a cheaper way? So if it's software, could a cheaper form of software do that same task? So looking for all of the opportunities to save and run your business more efficiently. And then the third is obviously, do I actually need that overhead? Is that something that I could take out quite easily without, and it won't actually have any detrimental impact on the overall business? So that's a really good exercise to do. Then we come on to know how you're doing. So this is where you put your forecast in place, you've got your anticipated monthly sales, your anticipated costs, and your anticipated profit, and you're checking in against that perhaps on a weekly basis at the moment to see how accurate is it. Because what we're trying to do here is predict the future, and then if that prediction is not accurate, we want to be tweaking it as we go along. Now, in a normal operating world, we'd be looking to do this practice generally once a quarter. That's good practice, but at the moment you need to be looking at it all of the time to go, right, is what I thought would happen, is that actually what is happening? The fourth point here, cash flow forecasting versus profit and loss. This is again a confusion, a challenge that I often come across when I'm working with clients. So people look at their profit and loss, they look at their net profit, and they say, well, how come that money's not in my bank account? Well, there's lots of reasons why, several reasons why, but your profit and loss forecast, which I've been talking about up until now, is different to your cash flow forecast. So your profit and loss is really just telling you, are you selling your product and service profitably, and are you controlling your overhead expenditure, and are you making sufficient profit? That's all it's telling you. It's not telling you whether or not that money's actually come into the business. So your cash flow forecast is showing you exactly that, the flow of cash in and out of your bank account week by week or month by month, so that you can start to plan accordingly. And there's some a few new pieces of software on the market now that do this for you. We use Fluidly for clients, which uses artificial intelligence to look at, it ties in with your accounting software, and it does a prediction based on the patterns of money that it's seen going in and coming out. But then you can also overwrite that, which obviously you would need to do at the moment because we're in such different times. And that's another thing that the bank will want to see. So they'll want to know, are you profitable? Are you running your business in a healthy way? But also, what does your cash flow look like? So if there's any element for them that they're undertaking, obviously that's the sort of thing they're looking for to give them that confidence. And I think just from my own experience, what I'm hearing, a lot of people who've been turned down for loans, it's because they haven't been able to provide this information. And then the fifth point there, scenario planning. Again, this is something that Fluidly and this cash flow forecast software does for you. It's very, very clever. You can literally start to put in different plans. So you can ask it, for example, okay, if I am successful in getting this loan, what does that do to my cash flow? What about if I feel I'm ready to bring somebody back? I'm being asked that quite a bit at the moment. People are saying, should I bring somebody back? I think I've got enough work. But so rather than it be a finger in the air decision and gut instinct, which is quite dangerous, there's lots of tools on the market that can help you to give you this visibility to make those decisions. So it could be extra investment, it could be hiring a new member of staff, it could be bringing somebody back from furlough, anything that has a financial impact on the business. If this software is linked in with your accounting software, then it will give you that information, which is just vital in order to make the right decisions. So I hope that that's been of some use. Rob, can you hear me?
Tony.
Thank you, Rob. Thank you, Alison. Good morning, everybody, and thank you, Rob, for inviting me along as well. It's really a continuation of what Alison was saying regarding cash flow, because as business people, we all know that basically cash flow is king, and at this sort of unprecedented time in our history, the one thing that we must do is really to have a strategy for the business to make sure that we do come out the other end. And when I speak to my clients, I basically look at it in two ways. And stage one is to stabilise where we are now, and then stage two is to see what we can do going forward. So when I look to stabilise, it's really looking and seeking forbearance requests to our current providers on both a personal and business level. And the easiest way to do this really is to look at the bank statements. The business bank statements will give you all the direct debits, all the standing orders going out, as you know, and to look at each individual line to see whether or not it is viable, if possible, to go to that particular provider to see if they will give a repayment holiday in any way, shape or form. A good example of that is one of my clients has 6 vans outstanding at the moment with Renault. Renault Finance Solutions, they basically offered him a 4 months repayment holiday from April all the way through to the end of the summer. What will happen with those payments is they simply get put onto the end of the agreement. So it was a 36-month agreement. He's taken the 4-month repayment holiday, and those 4 payments will go on the end of the agreement. So rather than a 36 months, it becomes a 40-month agreement. If you look at this from a business and a personal point of view, as Rob mentioned in his previous slides, your mortgage provider, rent providers, these people also will be able to give you assistance and as such give you breathing space while you decide what to do. So once you've got that, once you've stabilised what you've got, what you're paying out, really time to look at what capital injection the business needs to get through. Go down the route of government grants, because there are government grants available, but also you have got the government-backed loans in the form of the CBILS, the Coronavirus Business Interruption Loan Scheme, and the BIBLS, the Bounce Back Loan Scheme. Starting with the bounce back loan scheme to begin with, this really is meant for the smaller trader, the individual, the SME, who is looking to borrow up to £50,000. It's from £2,000 up to £50,000. Features of this particular facility is the fact that you do not make any payments for 12 months. The interest, which is 2.5%, that is actually paid for by the government as well for the first 12 months. So again, that gives you breathing space. So in theory, you could actually take £20,000, £30,000, put it in your bank account, keep it there, and at the end of 12-month period, you can actually pay it back if you haven't used it totally free, because there are no early settlement no early settlement penalties for such a facility. The application process, you would go to your bank through their website, and you'd apply through the Bounce Back Loan Scheme link. It's a self-certification process, so quite simply, there are about 5 or 6 questions that you will ask. You self-certify that those questions are correct, and then normally, if you get accepted, and I understand that at the moment it's about an 85% acceptance rate, at the end of 2 to 3 days, the money miraculously will appear in your bank account. If you're looking for more than that, if you're looking for over £50,000, from £50,001 all the way up to £5 million, then it is the Coronavirus Business Interruption Loan Scheme. This is a far more complicated process, simply because on this particular occasion, the government is backing it to the tune of 80%, rather than the Bounce Back Loan Scheme, where the government backed it to the tune of 100%. As such, you will need to provide financial information, you will need to provide a business plan, and also you will need to provide information which basically says, but for COVID-19, where would my business be now? So there are 1 or 2, quite a few forms, forecasts, budgets, cash flows, etc., to complete, which then go to the bank. The bank will then look at it as a completely new proposal, and depending on what they decide to do, whether or not they will then take that forward to the British Business Bank for authority. So quite simply, look to see whether or not you can manage on £50,000 or below, which is by far the simpler route. Or if you do need more, then really you just really need to get more information, go through your bank, and then you'll get the money that way. Rob, back to you.
Thank you, Tony. I think that's fairly comprehensive and very useful from both Alison and Tony on that score. So if you can both make sure you're unmuted, I'm going to ask you some questions, and Omar can come in and help us out as well from what the feedback in the audience is like. I'd like to kick off by saying, it sounds like you're, from Tony's perspective, you're saying that in examining where you are now, there are lots of options that can be done with your existing lending, either to phrases like restructure financing and may make sense to anybody within the finance sector, but outside of it may sound pretty alien and troublesome, but actually this might just be a matter of having conversations with existing lenders or moving mortgages, overdrafts, banking facilities around. Is that correct?
Yes, it is, Rob. I think the asset finance houses and the independent banks have kind of moved a lot quicker than the main banks on this particular occasion, and they are looking to work with clients to reschedule existing debt in order to help them come through the other side. It's a win-win situation, because if you were sitting in the asset funder's position at the moment, the last thing you want is to have the assets that you've funded coming back, landing on your doorstep at the worst possible time. So as far as that is concerned, they will work very closely with clients to make sure that they get what they can. And to be fair, the major ones, they're doing it for 3 months. So they do a 3-month moratorium with a review. So it's gone from 3 months, and then in the end of 3 months, you'll have another review, which is basically on the end of a phone line. And if you need another 3 months, they would be open and willing to give that other 3 months as well.
It's worth saying, because I'm a lawyer by trade, nobody wants you to go bust, because as soon as you enter that insolvency situation, a moratorium comes in, whether it be until there's further announcements explaining the government's relaxation. This moratorium comes in under liquidation, administration, or any other insolvency process, freezes that debt, and then you pay everybody out in preference order, which means unsecured creditors get paid at the end. Quite often in any insolvency scenario, there isn't enough money left in the business to pay the creditors. So invariably, taxman, banks, people do lose out, and therefore, which is why I say nobody really wants people to go bust.
Correct.
Alison and Tony, construction tends to get a bit of a rough ride. The value of the contracts can sometimes disappear when insolvency or something happens in that case, leaving assets like a lease on an industrial unit, a couple of fleet vans or something which might be on hire purchase, and some office equipment. Do you think there's been a resistance from the finance sector to help construction out because it's so SME concentrated?
If I answer that first, Alison, as far as the funders that I deal with, they are very hungry for yellow plants. And at this particular moment, they are happy to provide a refinance, sale and leaseback for unencumbered assets, which is supported by a coronavirus business interruption loan scheme. So it's not only the banks that are able to do this. You have the independent finance houses who can do it via asset-backed facilities, or they can do it on invoice financing backed facilities as well. So my view is, as well as approach a bank, if you do have assets on your book which are unencumbered, there are quite a few finance houses out there at the moment who will buy those assets from you over a specific term, and that can also be civils back to.
Okay. And are they quicker to react? Because some of the complaints that have come through are, my existing bank, who I thought would prefer me, has taken 14 weeks to say no.
Yes, they are. We're talking 3 days from the time of getting the information to the time they come back.
Alison, do you have anything to add?
Yeah, I mean, I think your question was around, do you think they're getting a rough ride? All I can judge it on is I guess the success rate of the clients that I have that have gone down the route of first of all applying for CBILS. Obviously, BIBLS is pretty straightforward. They've got that. But a lot of people that I know were turned down for CBILS, and it comes back to what I was talking about in terms of it's the quality of information that they were providing, because there was that 20% of the loan that's still backed by the bank. Obviously, they're looking to make sure that that they're covered, and so it's the quality of information that you provide that will give them that confidence. But certainly the clients that I've got that have been successful, those are the people that are on top of their numbers. They know their business, they know how they're operating, they're able to present it in a structured way and show a cash flow forecast. Their profit and loss is up to date. They know their business, and therefore they've been successful.
And you mentioned before, we've been in previous conversations, because Alison was one of our leads when we've done podcasts on growth and prosperity in business. You've mentioned before that financial literacy is one of the keys to success in growing a small business into a medium and then a large one. When we had that conversation before, there was no clear answer from any of us as to how you find a really good accountant or somebody who is financially literate that can show you how to do that. it sounds like in the meantime, things like fluidity have come along and made that
yeah.
easy.
Yeah. Yeah, I mean, definitely there's some clever software that's available that is really simple to use, and providing there's somebody there to, I guess, show you. It's I would say that some accountants are fantastic at, and certainly when I've looked back over the last 4 to 6 weeks, you can see those that are really proactive and on the money, excuse the pun, because they're communicating with their clients regularly, and updating them. You know, things were changing, weren't they, so quickly. Every 2 or 3 days there was a new piece of information coming out, and there were accountants out there that definitely were on top of it and were offering that advice. But I would say your accountant should be, they're really, really busy at the moment. It's certainly one of the services that we provide as well. But you know, we're relatively small, but they should be able to help you with getting the most out of your accounting software. And they should be aware of software like Fluidly that is so easy to plug in, and then it's just a case of either watching the videos or somebody taking you through how to use it. But once you know, it's like anything, isn't it? You don't know what you don't know sometimes, but once you know, then it's very easy to do. But it's the, you know, I would say 95% of our clients, when they first come to us and we put objectives together for a program, financial literacy is always up there. And I wouldn't say that this is exclusive to construction or trades at all. I would say it's common in many businesses, and it's often where people perhaps are frightened of the numbers. They think they don't understand them. They haven't been trained in that aspect, you know. So you may be a vet, for example. It's not just construction or trades. You know, you've learned your trade, your skill, your technical skill, but at no point in that training has anybody ever sat you down and talked you through a profit and loss and actually what it means and the ways to manage your cash flow better. And then on top of that, a lot of accountants haven't offered that proactive advice. You know, they're compliance accountants. They do what is required for HMRC, but they're not as proactive as what they could be in terms of offering advice and seeing opportunity in a business and feeding that back.
Okay, thank you very much for that. I think I completely agree with you there. I mean, some accountants are great. It's a bit like lawyers. And actually, I'd also agree with you on the skills set. My skills profile might read solicitor, mediator, business advisor, cabinet office. Doesn't mean I've ever been taught or have great financial literacy skills. My skills are in words, not numbers. So I'll come out and confess on that one at least. But it's a very interesting place to be, because I think one of my tips I'd give anybody, whether you're looking at communication software, as we've all entered the world of using Teams, Zoom, GoToWebinar and other things, when you look at software packages, look for how they're going to charge you. I used to do a lot of technology contracts, and they may try and upsell as they tend to do a per user or banded user license system. That can often be the best way to get started, and that can work for QuickBooks, Fluidly, and other software systems, right through to construction and projects software systems like pay apps and OpenECX as payment management platforms and those kinds of other issues. I think the other point, it's interesting that don't forget, as people employing accountants, where you outsource somebody, whether it be a lawyer, an accountant, health and safety, or IT, they will tend to engage them to do and no more, because that's what they priced. You're a contractor, you understand that. Anything else becomes a variation. Therefore, if you've engaged a bookkeeper to simply do your returns, as Alison described, the compliance accountant, don't be surprised that they aren't proactively modelling your finances for you and approaching you with this information. They may have it, they may be doing it for larger, more financially beneficial clients, if you like. You have engaged them for a more extensive service offering. You have engaged them to come into their business and do that kind of exercise for them. So it's worth realising that you sometimes also get what you pay for. I have sympathy for our clients, but sometimes not when they shoot themselves in the foot and can wonder why they haven't got something when they didn't actually ask for it. And that's me being tough on you guys. Omar, what have we got from the chat thread?
Thank you, Rob. And first of all, thank you once again to all our panelists for a very insightful discussion there, helping us to digest some pretty complex financial topics. So before I launch into some of the audience questions that we've had, if you want to reach out to Alison and Tony, I believe we have their details that we can put up on screen with their contact details. There you go. So just jumping into the questions here, we've got one from Richard Royal. Should I be planning for any additional overheads from staff working from home? Are they entitled to claim back any costs, i.e. utility bills, etc.?
Okay, again, that's really something to discuss with your accountant. This came up on another webinar the other day. Certainly, yes, if you have incurred additional costs through having to work from home through this period, then you can claim a percentage of the utility bills on your tax return. You just need to be a little bit careful, and this is why I say do check with an accountant. You need to be a little bit careful around what that percentage is, because it can have implications, I believe, when you come to sell the property. How they would find that out, I'm not too sure, but just make sure that you do have that discussion with your accountant. But absolutely, if you've incurred additional costs, then they are tax deductible.
I think it's also going to come down to what those costs are. Ephemeral costs or kind of harder to quantify ones like utilities are going to be pretty tough. And as an employer, you might have a discussion as to whether or how they offset against savings from working from home as well. Yeah, whereas I think there is also a PAT, I believe that's the number of the form, that if you're an individual who's incurred costs, you can get some kind of tax relief on it. That's more for things like furniture in the home that is solely dedicated to working from home. And I believe HMRC has been inundated with a bunch of those forms that can be done online. You want to be careful, because you might go from being an ordinary employee of a business to suddenly be having to self-certify or self-assess yourself, and not necessarily wanting the aggravation that comes with that.
Rob, can I add something to that?
Mm-hmm.
One of my clients is an accountant, and he was speaking to HMRC, and they advised him to advise his clients to include a line for COVID-19 for 2020 on his P&L account. So to isolate the COVID-19 costs in order that it can be 100% offset against the P&L account.
Okay, that sounds wise. As we've all had budgets, you can then have a definitive perspective.
Yeah.
Okay, we have time for a couple more questions. One from Joe Divily. If you apply for the bounce back loan for, say, £20,000 and you receive it, but then because of the uncertainty you want to get more and subject to your turnover, can the loan be topped up, or do you need to make another application? Is there a date? I guess this is a follow-up question. Is there a date when the bounce back loan will not be available?
The bounce back loan is available up until the 3rd of November. That's at the moment, and with the possibility of extending it in case of need. With regards to topping it up, the answer to that is yes, you can, but when you apply for the original bounce back loan, you're asked whether or not you have any other government support. And when you apply for the top-up, you have to basically say that you've already got in place a bounce back loan to the tune of whatever you've got, and then you would have to self-certify exactly what your turnover is to make sure that it complies with the 25% rule stroke £50,000 mark, whichever is the lower. So if your turnover hasn't gone up and you're already on the maximum, then it will be declined.
And if you've got a bounce back, Tony, you're not allowed a Sybil's, are you?
Correct. If you can't have the two. I think what they're saying at the moment, if you've already applied for a Sybil's and that Sybil's is £50,000, it can be converted to a bounce back loan, but that has to be done by the 3rd of November. But you cannot have the two.
Okay, so we've got one more question here, again from Joe, relating to the whether the risks have increased since COVID-19. The question is, how do you check the creditworthiness of a company that was okay in January but might have suffered because of the shutdown?
I'll let you take that, Tony.
Okay. It's a very good question, and the bottom line is if the loan was being underwritten, it'd be underwritten on historic information. So you would see how the business performed up to 31st of December 2019. Look at the quarter 1 figures for 2020, and then look at the projections from there. Now, each fund, each bank does ask the question, how has the business been affected? And it's how you actually portray that to see whether or not the bank will actually accept that loan. Now, I'll take it all the way back to what Rob said. It is really the Sybil's facility, coronavirus business interruption loan scheme. It is a but-for situation. So if you're trading profitably, everything is looking good prior to the COVID-19 outbreak, and your figures show that, and your credit rating shows that, then there should be no reason why you wouldn't be looked at positively for a Sybil's loan.
I think I'd add to that as well that in case the other dimension to this question is when you're doing business with other parties, how do you credit check them? Experian, credit reports, risk disc, whichever one you go with, there's always been a snapshot in time. And therefore, when you're coming out of any economic crash, they tend to be really much more limited use because they're so historic. The other ways to check is, and this is legitimate, site gossip. Ask other trades, because if everybody's got a problem getting paid, then it ain't just you. It clearly indicates that the person doing business with all of you has a problem. Material suppliers, great place to start. They are hot on credit risk, and they will shut you down as soon as there is a sniff of a problem. So if the material suppliers are willing to either formally or informally and casually mention that this party has a problem, then you know that you should have a problem with them too. If you have any worries about their financial jeopardy or volatility, you could take measures to sustain your risk by increasing payment cycles, shortening them. We've done it before where we've said, right, no, this contract's not going to be your usual monthly cycle. We're going to reduce it to fortnightly. Payment periods, we know the industry works on anything from 30, 35, 45, 60, 90, up to 120 odd days. The longer that period is, the more you are exposed as a business, and you shouldn't be. So right now, You want to be part of the webinars that I've given on contractual issues is about how you reduce your contractual exposure to cash flow issues by minimizing those time periods. And I think you've got to go through that exercise alongside what the ones Tony and Alison are endorsing and outlining to you here today. It's only in that way that you'll be able to credit check your clients. And we've even done it before. We've said, right, you've got to pay us in advance for materials because we're not sustaining that cash flow for you. You've got to pay us fortnightly, and we want a personal director's guarantee to back up the business because it looks so shaky. That's the only way we're willing to do business. Thanks, Emma.
Okay. Thank you, Rob, and thank you again to Alison and Tony for joining us today. Just a reminder to our viewers that a full replay of this webinar will be available on ECA's YouTube channel, youtube.com/ECA Live. And we have a host of more information and guidance and materials related to business recovery as we emerge from the lockdown. Please visit www.eca.co.uk/business-recovery for more on that. And thank you once again to everyone, and have a wonderful day.
Thank you.
Thank you.
Thank you.